Welcome to Echo 315, Study Session 6, Financial Analysis. Introduction. The financial statement of any enterprise represents the summarized data of its assets, liabilities, and equities in the balance sheet and its revenue and expenses in the income statement. If not analyzed, such data may lead you to draw erroneous conclusions about the firm's financial condition. The main measuring instrument that you can use to evaluate the financial health of a business include horizontal analysis, vertical analysis, and ratio analysis. Analysis of financial statement involves the calculation of various ratios, which is used by such interested parties as creditors, investors, and managers to determine the firm's financial position relative to that of others. The way in which an entity's financial position and operation results are viewed by investors and creditors will have impact on the firm's reputation, share price, and effective interest rate. In this study session, we'll examine horizontal analysis and vertical analysis and ratio analysis. Learning outcomes. When you have studied this session, you should be able to 1. Discuss the rationale for carrying out financial analysis. 2. Explain the sources of information for financial statement analysis. 3. Highlight the methods of evaluating the financial health of a business. 4. Highlight the types of comparison with ratio analysis. 5. Discuss efficiency or profitability ratio and its types. 6. Explain the various forms of short-term solvency and liquidity ratio. 7. Discuss the types of long-term solvency and stability ratio. 8. Examine the components of investors/shareholders ratio. Financial statement analysis. Purpose of financial analysis. The purpose of interpreting account is essentially the art and the science of translating figures and financial statements so as to reveal financial strength and weaknesses. The analysis should hopefully help to identify the underlying causes which have contributed to the strength and weaknesses. Analysis help to evaluate how we did in the previous years, where we are, and possibly how we will perform in the future. Therefore, analysis may be concerned with both control and prediction. An analysis requires an overall picture of a business and should always avoid the danger of viewing ratios in isolation, as shown in Table 6.1. Buckley Corporation income statement for the year ended 31st December 2003 and 2002. In 2003, value of sales was 57,000. In 2002, it was 68,000. Cost of goods sold in 2003, 20,000. 2002, 17,000. Gross profit in 2003, 37,000. 2002, 51,000. Operating expenses 2003, 10,000. 2002, 21,000. Profit before interest and tax 2003, 27,000. 2002, 30,000. Sources of information for financial statement analysis. In addition to the balance sheet, profit and loss account and related notes, Useful information on company's position, performance, and prospect may be contained elsewhere in the company's annual report. Possible sources include chairman's or chief executive statement, divisional review, financial summary highlights, segmentary analysis, cash flow statement, ratio analysis information including earnings per share. The chairman's statement. This often includes a concise review of the company's progress. It may give some indication of likely prospect for the forthcoming year. Such information, however, is not subject to minimum legal requirements regarding content, nor is it technically within the scope of the auditor's report. Additionally, the statement is likely to emphasize matters which the board wishes to emphasize. Divisional review. This may provide an informative perspective of business activities, possibly with an indication of their relative importance in relation to sales and profit. Financial summaries highlights. These are clearly aimed at the non-technical readers and aim to give a simple overview of financial highlights. Segmental analysis. Since rates of profitability, opportunities for growth, future prospects, and risks to invest may vary among industry and geographical segments, users of financial statements need segment information to assess the prospect and risk of a diversified enterprise, which may not be determinable from the aggregated data. This will enable the users to make more informed judgment about the enterprise as a whole. Evaluating the financial health of a business. Horizontal analysis. This is used to evaluate the trend in the account over the years. For example, a 3 million profit year looks very good, following a 1 million profit year, but not after a 4 million profit year. Horizontal analysis is usually shown in comparative financial statements. Companies often show comparative financial data for 5 years in annual reports under 5 financial year summary. Because horizontal analysis stresses the trends of the various accounts, it is relatively easy to identify areas of wide divergence that require further attention. In the comparative income statement of Maynard Hicks Limited above, the large increase in sales return coupled with the decrease in the sales for the period of 2002 to 2003 should cause concern. You might compare these figures with those of the competitors to determine whether the problem is industry-wide or just within the company. It is important to show both the Naira amount of change and the percentage of change, because either of them alone might be misleading. For example, although the interest expense from 2001 to 2002 increased by 100%, it probably does not require further investigation, since the Naira amount of increase is only 1,000 Naira. Trend analysis of horizontal analysis by showing trends relative to a base year. In using this method, you choose a year that you consider representative of the firm's activity as a base year. You will convert each account of the base year into an index of 100. You will calculate index of each respective account in the succeeding years by dividing the amount in that year by the amount in the base year and then multiply by 100. For example, if we let 2001 be the base year in the balance sheet of Maynard X Limited, we will assign index of 100 to all accounts in 2001. To find the index of fixed asset in 2002, we'll divide the fixed asset figures for 2002, that is 90,000, by that of 2001, 85,000, and then multiply by 100, which gives us 90,000 divided by 85,000 times 100, which equals 105,882 naira. This process yields an approximate figure of 105.9. In the same way, the index of fixed asset in 2003 will be 117.6. The condensed form of the balance sheet of Maynard X Limited using trade analysis is shown below. Vertical analysis. In vertical analysis, you use a significant item on the financial statement as base value and express all other items on the financial statement relative to the base. Vertical analysis is used to disclose the internal structure of an enterprise. Vertical analysis of the income statement indicates the existing relationship between the income statement account, revenue, while vertical analysis of the balance sheet shows the mix of assets that produced the income and the mix of the sources of capital, whether by current or long-term liabilities or equity funding. To perform vertical analysis for the balance sheet of Maynard Inc. Limited, assign 100% to total asset and express each asset account as a percentage of total asset. Similarly, assign 100% to total liabilities and equities and express each liability and equity account as a percentage of the total liabilities and equity. For the income statement, assign 100% to net sales and express all other accounts as a percentage of net sales. The above analysis shows, for example, that the proportion of total asset financed by equity increased from 34.1% in 2001 to 37.5% in 2002 and further to 38.5% in 2003. This trend is due to the decrease in liabilities coupled with increase in retained earnings. Note that the value of paid up capital remains the same over this period. Types of comparison with ratio analysis. You can use ratio analysis to make two types of comparison, namely industrial comparison and framed analysis. Under industrial comparison, you compare the ratio of a firm with those of similar firms or with the industry average or norms to determine how the company is faring relative to its competitors. Under trade analysis, you compare the firm's present ratio with its past and expected future ratios to determine whether the company's financial condition is improving or deteriorating over time. Efficiency and profitability ratio. Return on capital employed, ROCE. This shows the overall profitability of the business. This ratio shows the efficiency of management in utilizing the available resources. It is referred to as the primary ratio. You will calculate this ratio by using the formula below. ROCE, that is return on capital employed, equals profit over capital employed times 100. The profit used may be operating profit or profit before tax or profit after tax, while the capital employed used may be net asset or total asset or fixed asset plus working capital. Return on capital employed can be decomposed into two secondary ratios, which are profit margin and asset turnover. The relationship between return on capital employed and the secondary ratio is as follows. ROCE equals profit margin times asset turnover. Asset turnover measures the efficiency of utilization of assets in generating revenue. It is calculated as asset turnover equals sales divided by capital employed times 100. And profitable because it is possible for a company to be efficient without being profitable, or to be profitable without being efficient. A ratio of gross profit to sales. This serves as an overall guide to the efficiency of production in a manufacturing business. In non-manufacturing business, it corresponds to the trade markup and serves as a valuable check upon the accuracy of the closing stock figure. Gross profit margin shows the profitability relative to sales after deducting direct costs. You will calculate it as follows. Gross profit margin equals gross profit over sales times 100. This ratio may be misleading as no account is taken of selling and distribution expenses, because a product which is costly to produce or purchase may incur very little selling and distribution expenses, and vice versa. Other factors that should be considered when interpreting gross margin include the stock valuation method, trade discount granted to customers, sales mix, and so on. Ratio of net profit to sales. This indicates the relative profitability of business after taking account of all income and expenses. You calculate these as follows. Net profit margin equals net profit over sales times 100. Ratio of individual expense to total expenses. This ratio shows the relative weight of each item of expense to total expenses. Expenses percentage equals individual expenses over total expenses times 100. Ratio of expenses to sales. This ratio helps to highlight the sources of the improvement or deterioration in the ratio of net profit to sales. Ratio of expenses to sales equals individual expenses over sales times 100. Short-term solvency and liquidity ratios. Current or working capital ratio. This measures the ability of a company to meet its current liabilities as they fall due out of its current assets. Current ratio equals current asset divided by current liabilities. Quick assets or asset test ratio. This ratio expresses the relative amount of cash and other assets that can be easily converted to cash that are available to meet current liabilities. Quick asset ratio equals current asset minus stock over current liabilities. Debtors collection period. This ratio measures the average number of days for which trade debt remains uncollected. Debtors collect period equals average trade debtors over credit sales times 365 days. Debtors turnover. This is the number of times trade debtors are turned over during the accounting period. It is inverse of debtors collection period. Debtors turnover equals credit sales divided by average trade debtors, which equals the number of times. Creditors payment period. This measures the average number of days for which trade creditors remain unpaid. Creditors payment period equals average trade creditors over credit purchases times 365. Creditors turnover. This measures the number of times trade creditors are turned over during the period. It is inverse of credit payment period. Stock turnover. This measures the physical turnover of trading stock during the period. The higher the stock turnover, the higher will be the profit and vice versa. Stock turnover equals cost of goods sold over average stock. A high stock turnover may be an indication of overtrading, while low stock turnover may lead to overstocking. Number of days stock in store. This measures the average number of days stocks remain in the store before being sold. It is the inverse of stock turnover. Number of days stock in store equals average stock over cost of goods sold times 365. Long-term solvency and stability ratio. Gearing ratio. This measures the degree of vulnerability of a company to the financial risk attached to fixed interest securities. Gearing equals fixed interest loan plus preference share capital over ordinary share capital plus reserves. Fixed interest cover. This measures the number of times fixed interest is covered by profit. Fixed interest cover equals FBIT plus fixed interest over fixed interest. Long-term debt shareholders fund. This measures the extent of cover for fixed liabilities such as loans and debentures. Long-term debt to shareholders fund equals long-term debt over shareholders fund. Total debt to shareholders fund. This measures the solvency of a business and indicates the extent of cover for external liabilities. Investors and shareholders ratio. Earning per share. This ratio gives an indication of the amount of net profit after tax and preference dividend attributable to ordinary shareholders. Earning per share equals profit on ordinary share activities after tax and dividend on preference shares over number of ordinary shares times 100. Price earning ratio. This measures the number of years purchase of the earnings of the company. Price earning ratio equals market price per share over earning per share. Earning yield. This shows the potential return on the shareholder's investment. Earning yield equals earning per share over market price of ordinary shares times 100. Net asset share. This measures the amount of net asset attributable to each share in issue. Dividend per share. This shows the amount of gross dividend declared on every issued ordinary shares. Dividend payout ratio. This shows the percentage of a company's distributable earnings that is being paid to the ordinary shareholders as dividend. Dividend payout equals dividend per share over earning per share times 100. Dividend yield. This measures the current actual return on shareholders' investment. Dividend yield equals dividend per share over market price per ordinary share times 100. Dividend cover. This measures the number of times the ordinary dividend is covered by distributable earnings. Dividend cover equals profit on ordinary activities after tax and preferred dividend divided by gross dividend. Summary. In this study session, you learned that financial statement analysis helps to reveal financial strengths and weaknesses. In addition to the balance sheet, profit and loss account, and related notes, other sources of information for analyzing financial statement include chairman's statement, divisional review, financial summary highlight, segmentary analysis, cash flow statement, and ratio analysis information, including earnings per share. The main measuring instrument that we can use to evaluate the financial health of a business include horizontal analysis, vertical analysis, and the ratio analysis. Horizontal analysis is used to evaluate the trend in the accounts over the years and is usually shown in comparative financial statements. In vertical analysis, you use a significant item on the financial statement as a base value and express other items on the financial statement relative to the base. You also learn that analysis of financial statement involves calculation of various ratios which are used by such interested parties as creditors, investors, and managers to determine the firm's financial position relative to that of others. This is the end of study session 6. Thanks for listening.